Hey everyone, I'm super excited to get started on this video, and this video is going to be a complete overhaul of everything that I have to say, everything from creating my strategy to building a watch list to executing the watch list in real time, and then also, how do you look back and how do you think about your performance on the watch list, how to back test and how to improve. So, I put this tweet out. We're going to go through about 8 different things. I'm going to take them roughly in order. First off, being entries using levels. Second, how to be selective with the stock, the stock and trigger selection process. And also how to be selective with trades. Third, taking profits, scaling. What does that look like to me? And I'll go through examples. Then there are also two additional parts of kind of entering, exiting trades, right? Stopping out, huge part of the trade, and we need to acknowledge it and know how to deal with it and have a plan for it. Additionally, letting winners run, that'd be the fifth thing. I feel like many people they'll be quick to sell their winners and they'll hold on to their losers for a long period of time. Well, that's a recipe for disaster. And then sixth, the mentality of cutting losers and how paper cuts can add up, especially in a choppy market. And that's probably one of the biggest points that I want to speak to. Seventh being re-entries. How would I re-enter a position? And what's my mentality and kind of the psychology behind it? How many times will I try something before giving up on it? And then lastly, the psychology behind recovering from large losses, but also the psychology behind taking large gains, because it's very important to not get too high with the highs or too low with the lows. So if you can't get the psychology, if you can't get the psychological part down out of all of this, then it's almost impossible for you to succeed while actually trading. It's, I would say, 90% in your head, 10% actually what you're doing on the computer, clicking buttons. So you need to find what works for you. What works for me might not be exactly what works for you. But once you find what works for you, you stick to that, you make a plan, you stick to it, and you follow through day in and day out. And if you break a rule, you identify it, and then you don't do it again. That is crucial. So first off, I'm going to start with a little bit of a technical perspective, and then I'll get into the psychological part at the end. So first off, I'm going to look at a trade from today, which is December 21st. So Cisco, what am I looking for in a trade to begin with? Right, this sort of speaks to being selective. Why would I want to be in a Cisco trade? Okay, well, it's in this pretty clear upward channel. And I know that if it closed at about 60.33 or 60.36, then I know that it can move either direction because it's really in the middle of this channel. So it can go up or down. So I'm totally fine with either direction. I'm not coming in with any sort of bias, because you come in with a bias, then you could find yourself becoming tunnel visioned. And if you're tunnel visioned to only buy calls and you say, oh, wow, I'm getting a cheap entry on these calls on a dip, but then what if the dip keeps dipping, right? And then if you're still convicted on the trade, you could average down and then continues to dip. So coming in with any sort of conviction, at least for me, has been, for strictly day trades, it's been not very successful. So I would say it's just from a broad perspective, it's extremely important to come into the market each day just with an open mind. Realize that anything can happen. Every moment in the market is unique. Don't come in saying, this is going to happen, because that is how you find yourself getting into some holes that are hard to get out of. So first off, how am I even getting these Cisco levels? So I'm noticing, I just want to notice what is a daily, an average daily move for this. You can use an ATR indicator, but just wick to wick, roughly what's a good move for Cisco, and it's about $1. So And I like to then think of my 20 to 25% rule, which is, what is 20 to 25% of that $1 move? Well, easy example, it's 20 to 25 cents. So after doing that math, I say I want my triggers to be about 20 to 25 cents away from my previous close. And my previous close was right here at 60.36. So you notice that my put trigger was 26 cents away. My call trigger was 22 cents away. Perfect. And I found that, nobody taught me that. I've just found that that's been the sweet spot, to where you're not going to get faked out and you're not letting too much of the move happen and then getting in late. You're not chasing. So when I'm finding these levels, I tend to stick in the 15-minute. So we can ignore these candles to the right. So I'll just stick them into the volume profile. And I'll say, okay, why 60.1? Okay, it's in my range that I want, and it's the bottom of these two wicks. It's pretty much the bottom here, body, body's here, body as well here. Great. Love that level. Okay, here, what about 60.58 or 60.6 basically? So if I raise it, it was a little bit off on my placing, but you can see we get those bodies there. We get the top of this wick. It's pretty strong. I could even take it to the 5-minute and just test it further, knowing that, okay, today was the 21st, so I'm looking at these. Nothing up here really. This looks good. Struggling to break above 60.6. Keep going back. Okay, yeah, there's nothing back there. So we see this continued struggle and inability to break over 60.6, and then when it does, comes right back down and provides a good breakdown, denial, and then back down. So entries, right? So we have the levels. Now let's use them for an entry. So first off, we see in the opening candle, Cisco goes up and it comes right back down. Well, I stay on the 5-minute. So I notice that the 5-minute candle never confirms above. That's what I'm looking. I'm looking for a 5-minute candle to confirm above the call trigger or below the put trigger. And what I'm looking for, if it's too far past, not directly above or below, I'm looking for a retest to possibly add. So what I like to think about is a few things. You can notice here on Cisco that it actually does confirm below the put trigger, right, for 5 cents. So that's not a huge move. So supposedly, you could take puts here and, it would be confirmed. And then you would see it go right back above the call trigger and you would probably get stopped out. So it's very important that you recognize these levels as key levels, because if you take something on a break and then it immediately invalidates it, you have to get rid of it. Because if you were to have, taken them down here, watch them come back up, and then see the break back above, your thesis would be invalid, and therefore you would need to cut the position. It was unable to make lower lows, those puts, you would have stopped out of those puts. So next thing we see here is, well, the great thing about this strategy is you can play it both ways. So we see same thing as we saw way back there, the last few days, the struggle to break over this and actually get any sort of confirmation, but boom, we do get the confirmation, okay? Suppose you enter here, boom, there you go. And then even when we get this drawdown, maybe at worst we're break even, but we're still above our level, and then off to the races. So that is a textbook trade. But the important thing to notice is these are almost similar right here. This is almost similar to this. And what is important to know is that you're not the problem, right? I mean, sure, maybe your levels could have been better, but as long as you have discipline, this move isn't going to kill you. And then this move you will make money on. So it's important to realize that, not every play is going to go like you wanted it to go. What's important is that we prepared for the possible move, and then we took the action that we planned to take. And then in this case, if you stopped out, you actually followed your hard 10%, 15% stop loss and you stuck to it and you didn't let this get out of hand right here. It even gave you a little bit of an opportunity to get out here, but you didn't let it form into this uptrend that would have just continued to destroy your gains. So same thing. So, suppose you take minus 10%. That's what I like to stick to. Suppose you take minus 10% here, and then suppose you go right back in on Cisco here on the confirmation, you probably get 10% really quick here. Comes back down, if you cut it there, great, you're break even on the day. Or if you hold through this, you're great. Your winner far outweighed your loser. And so this brings me to being selective, right? So does this look like a good trade to me? Well, I noticed that over time, this call trigger, has been tested many, many times, unable to be broken. And then I get my confirmation. I notice it's been tested, and then finally get the confirmation. That would be a high confidence trade for me. As opposed to over here, if we're to take these just on this initial break with no confirmation, that's not being selective. Sure, maybe you can take a lotto position or half size and then look to add it later, but this would be an example of a position where you're not being selective. You're almost just throwing money in there and hoping that it goes in your direction. So what I love about this Cisco example is that there is a trade, not even bad trade. There's a trade that doesn't go our way. There is a fake out, and there's a trade that goes our way, all in a span of an hour and a half, 2 hours. Perfect. Analyze these things. Look back and analyze them. Because, what am I noticing about this Cisco put level? Why did it support? Okay, well, I can go and look at SPY. I love using SPY as a tool. So if I have Cisco here, okay, what time did this happen? This happened at 9. So what is SPY doing at 9? Well, we can see that SPY was rounding out on the bottom. And if we notice that SPY has some wicks to the downside and was actually not making lower lows, we ideally would have not entered a put position here because we would have seen that SPY could have been building up support. And then we would have noticed that maybe long is the way to go here, at least for the breakdown or the breakout. So, conversely, what am I thinking when this breakout happens? So at 10:35, what is SPY doing? So at 10:35, SPY has gone up, made a double top here. And you can obviously see this inverse head and shoulders that's forming. And then 10:35, boom, you see this candle SPY just made. It basically perfectly completed this inverse head and shoulders. And so you can say, man, this thing could definitely rip to new highs of the day. So thinking about being selective, well, SPY is not saying that we're going to keep going down yet. It shows signs of building support. That was for the short play. But for the long play, SPY's ripping. Just completed a very bullish formation and huge candle with high volume. I mean, for me, being selective, that is a trade that would be considered, positively selective, A+ setup. So worked out in our favor, and then maybe at worst you were break even here. Maybe you scaled some here, again, at worst, break even. I would say you'd probably be up like 1 or 2% here and then, off to the races. So being selective, use all the tools that you have in your arsenal to build a thesis behind every single trade. When you go into a trade, make sure that you have a predetermined loss. If you go into a trade and you're saying, oh, well, I just think this is going to go up. Oddly enough, every time that I've thought, man, this setup could not look better, every time I think that, it always goes the opposite direction. Like last week, the Qualcomm setup was way too good, bullish, way too good. And then what happened? It knifed about 10%, in one day. So they just totally pulled the bottom out. So it's very important to have a predetermined loss in your head. For me, that's 10%. Do I always stick to it? No. Am I a perfect trader? No. But what you should do is have a predetermined loss and a thesis for every single trade. It's very important to do so. Like, we're always calculating how much we can gain and how many Lambos we can have, after our trade. But the important part is that we have both sides predetermined. What I like to do, suppose I enter this Cisco trade. What I'm going to do is I'm just going to go back and I'm going to look for 5-minute levels. I know a lot of people like to use EMAs for their scaling. I mean, there's so many ways that you can look for profit targets, but for me, I really keep it super simple. And again, I look at EMAs. I look at everything that everybody else looks at. However, this is my favorite way of looking when to scale out. I just go and I plot levels on the 5-minute chart. And so I'm taking these just from top of these wicks here. I'm using that, and then the top of this body, and then kind of that body, top of that wick. And then the last thing would be probably this. Not much to really work with, but you can see, even though it's not much to work with, these levels actually get incredibly respected. If I would have said that's the very tippy top right there, then I would have scaled at the very top right here. I mean, you could have gotten about 3 more cents, but I would have seen it go up there, and then boom, I would have scaled out, and I would have not had to wait through this 15 minutes of downside. Sure, it continued to rip, but this level proved to be strong, right? It broke, tested, and then went back up. So that's my strategy. And back testing it always works pretty well for me, and I'm very happy with it. So again, keeping it simple. So being selective, use what you have, whether that's MACD, RSI, EMAs, volume profile. I do love the volume profile. Whatever you have in your arsenal, use it, and use that to help you make your decisions. Add everything together. The more things together that help you make a decision and that say the same thing, the better, the more, higher likelihood that is a trade that is high confidence, right? Throwing something into this candle off open, you're probably going to have about one thing, and that's the price action. So, I mean, the more things you get indicating that you should be in a position makes it a higher confidence play. So that leads me now to taking profits. So you're in a profitable trade. Suppose you entered here, and then you see this candlestick up here about 15 cents, and for Cisco, that's a huge move. If we already calculated that our average daily wick to wick range is about $1, 15 cents is more than 10, that's 15% of that entire move. So I guarantee you these contracts saw a huge move. So I would, my usual thought process is at about 20%. And if it's more choppy in the market, I'll keep it to maybe even 10 to 15%. But that's where I'm scaling my first third. And the important part of that is you can make any trade green if you just take profits when they become available to you. You see 15 to 20%, take it for, some half, maybe third. Sometimes I'll do a half. Here I probably would have done a half, noticing how, extended this move was, thinking that there probably would be some sort of red coming, because look, every extended move would have its drawback. This one had drawbacks along the way. And then boom, extended. Okay, cool. So I probably would have sold a third, if not half, into this momentum. I always like to sell into momentum. I'm not waiting for it to pull back. And then as I scale out of that, I have already put some profit in the bank and taken some possible downside off of the table. Perfect. then my next thing that I'm doing is I'm setting a stop for break even, because the last thing I want is a green position to turn red. And then, it's literally stress free at that point. We get a position that goes green, we take some off, and then we can even take more off. Like, we see it start coming down, and we say, oh, well, this breakout must be failing. We can sell some at 10%, say we sell another third at 10%, and then set the rest for break even stop. I mean, that is a stress free trade. It's basically free money. That's why entries are so important. You just need to, if you can get high quality entries, then you can allow yourself to have a plan and execute it well. So suppose we never get this drawback. What I kind of look for is, the next leg in my direction. Like, suppose we got up here on the next candlestick, which would have been crazy. I would have sold another third here, or if I sold half here, I would have sold another 25% here, and then I'm just raising my stop the entire way. So Facebook was one today, actually, that I did do this on. So what I did with Facebook was it didn't perfectly align to a level, which is rare for me, because my mentality, and I'll go back to Cisco just for a second. My mentality is, if I'm entering a position that's past my trigger, what would my loss look like if we got a retest of that trigger? So what I mean by that is, suppose I take puts here at 60.5. What is my position going to look like if we get that retest at 60.1? Well, it probably wouldn't be that bad. It'd probably be less than 10%. So I know that going into it. So ideally, this is where I'm buying the puts. However, if I take a position here, am I okay with what's going to happen if I get here? And then if we go back above, am I going to be able to cut and still be under 10% or 15% or whatever my predetermined stop loss is? Same thing here. If I buy up here at 60.65, am I going to be okay if we get back down here and then still allow myself a little bit of leeway to drop below it and realize, okay, like, my thesis is invalid, I need to get out? That is a very important math that you need to do in your head before taking a position. If you always wonder, is it too far gone? Well, if it's too far gone, just let it go. If it comes back and gives you the retest, then perfect. That's what you want. That's a great entry as well. If we had this and then we saw a pull right back down here to 60 and then a bounce, that's the ideal ad, obviously, but that doesn't always happen. See, it didn't happen here. You could have maybe taken puts thinking this was a retest. Well, if you took puts here thinking that this was a retest and then it went above, you could have just cut them for barely any loss, and realizing that your thesis was invalid. This is all about preserving your capital and entering right around the levels. If you play these key levels, and even if you pick the wrong direction, if you enter as close as possible to these levels, then it makes your capability for gain better, and it makes your capability for loss even less. If you just play as close as you can to the levels. So here is an exception of that. I'm glad I could talk about, how to play close to the levels, now only to tell you how to not. So what I did today was I noticed that Facebook was building a support here around 333.75. And we had gotten one test, and these were my triggers. These blue ones, I believe, were my triggers. We got a test. Actually, these might be different. These are different triggers. However, there was no, this was not my put trigger. So I noticed that we tested this level 3 times, right? Here, 4 times even. And so I noticed that we were bouncing. Okay, I took calls off of this bounce here and rode these up. So we get this nice move up here. I noticed that this is kind of where the range has been stopping recently, so I scaled out a third here. Sure, this was about 12%, but I'm happy to take some gains here, and then the worst case scenario, I just stop out of the rest, break even. It's still a stress-free trade. Cool. And then Next thing that happens is I get this leg up here. Great. I took off another third here, and I'm basically just riding with a break-even stop still. And after that, I I sit through this, and then we get two more legs up here, right? So first scale was on the first leg, second scale was on the second leg. And now I'm kind of just in these stress-free runners, so I can give it a little more leeway. And then as we get up to this leg, I set the stop loss for about 12%. And then we get up here, boom, okay, I raise the stop loss again to about 20%. And then this one actually catches my stop loss, unfortunately, before the big run. However, this is just an example of, even though, levels can be set out the night before, you can still play intraday levels. If you see something that's extremely strong, like this 5-minute level right here, you see much agreement with it across time, and especially in today, great time to take calls off support, right? There's, you can play the breakdown or breakout, but you can also play, I like to call them safe ads. You can play safe ads, right? Taking calls off support and puts off resistance. So what I want to look at is, what was SPY doing 925, 930, 935, because that's what impacted my decision. So 925, okay, hugely red. 930, slightly less red. And then 935 was recovering, okay? So what we saw here was Facebook. Okay, big red, slightly less red, recovering. But look at that recovery. So I knew that this was going to be a key support. And while SPY didn't have a lot of, push on that recovery candle, Facebook had a huge push. And I entered as soon as I saw it go back above the top of this wick, because that showed relative strength against SPY. And I said, we've held this support 5 times. I'm going with it. Boom. Okay, great trade. So scaling out profits, okay? Do it in thirds, do it in halves, take some out along the way, set break-even stops. Never let a green position go red, okay? Stopping out, we want to get entries as close to a level as possible. Suppose we took, here's another great example. Facebook fakes us out. This is not a good entry because we never got our confirmation. But look here, we get confirmation. However, Facebook is, almost $1 above our trigger. What would happen if we took calls here and then it came all the way back down here? Well, we'd probably be down like 10 to 15%. That would be too much. So we would not take this. So boom, we get this. Okay, well, it's green again. We just let it run. We let it go. It's whatever. But boom, look, we get a retest right here, down within 30 cents or 22 cents of our entry, or of our call trigger, sorry. But you can also notice that this level correlates perfectly with high of day, pretty much. So we can say, all right, if we get a test of high of day, previous high of day, or even better, our trigger, then I'll go long. Same thing as the, break below the put trigger, retest up and back down. Same thing here. We get the breakout. We don't take it because it's too far away. We don't take it here still because it's too far away. We wait for the retest. Comes down to a significant level and we add. Boom. Look at the candlestick. Bang. Okay. Just it does not stop. That is a perfect entry right there. Perfect. What we're doing is we are being selective. We're entering with levels and stopping out. What are we going to do with stopping out? If we enter here, we're going to end up stopping out about right here. We should be buying on this level, not selling. So that's why we're selective, and we don't take it unless it makes sense. However, say we do add calls here, okay? We get back below here. What are we at? Probably minus 5 to 7%. We cut them. We stop out. We must keep the winners big and the losers small. Think about it. If you have a max stop loss of 10%, and say you're playing with 10% of your portfolio on any given trade, which obviously we all play with different position sizes. I don't use 10%, but just for the sake of quick math, say you use 10% of your portfolio on every trade, and your hard stop loss is set for 10%. Okay, the max you can lose on any given trade is 1% of your account. Now, that's nothing to be scared of. That's just math. But suppose your average winning trade is 20%, since that's our first scale point. Say every time you see 20%, you scale the entire position. You can literally lose double the amount of times that you win and still be break even. So you can lose 4 trades and win 2 in a day, and you will be break even. So that's why I argue winning or entries are crucially important and are as close to the levels as you can, and then be prepared to stop out. You must keep the losers small. If you have a thesis going into it, a predetermined loss amount and a predetermined gain amount, you can't let that thesis become invalid and still hold the position. If you see your thesis become invalid, you must get rid of it. Next, that brings me to letting the winners run, right? So why did I not let this run? Well, I was moving up my stop loss. So I can't help the fact that Facebook is going to have wiki candles, but what's important to do is leave yourself some space to let the winners run, because nothing is just going to go straight up, right? If you're in a position, you've already scaled some out, you should be asking yourself, am I being given a reason to get out, right? If you see this come down here and then come back up, you see, am I being given a reason to get out? No, I'm not. But then you see this, and I can't help but sell into momentum up here. Can't help it. And I'll say, well, look what happened last time it was up here, it just wicked right back down. So it makes sense to me that I would scale some there. That's only smart. And then I set my stop loss for probably what would be about right here. So I'm fine with that. If I stop out, I stop out. And, I did. But the thing is that I tried to let my winner run. I gave myself a conservative stop loss. I knew that I'd already taken off some here, and I've already taken off some here. So it was a stress-free trade. We don't need to stress out about a trade when we have already confirmed that it's green. And shoot, you could even set it at a break-even stop loss. But once you've already confirmed that the trade is going to be green regardless, just take a deep breath and realize that this is a stress-free trade. I can't possibly lose it. Just observe the chart. You can put a stop loss in. You can keep raising the stop. You can use a trailing stop. Just ask yourself, is this giving me a reason to get out? Who knows? That's the question that I ask myself. So next, I gotta discuss the mentality of cutting losers. So let's go through a couple examples from today. So paper cuts adding up, right? It's just horrible. So Peloton, what does this chart tell you? This chart says that it was extremely choppy today and there was no movement. So really, really frustrating if you took these. So, obviously a rejection off of this call trigger could have been done, but, I wouldn't have recommended it. I didn't do it. It would have been a difficult trade. It would have been a quick trade, but, additionally, you could have taken, calls off of this. But when you see SPY having actual movement, I'm hesitant to take range-bound trades because, I'm always looking back and forth between SPY and the stocks that I'm trading, and I don't want to see SPY, making higher lows or lower highs, and actually being in a trend, and then trying to play, a range-bound play, because if SPY is breaking out or breaking down, the stock that I'm trading is likely to do the same thing. And if SPY is choppy, then, the stock that I'm trading is likely to be in a range. So to be honest, I wouldn't have expected this to trade in a range. However, it did. And so it's important to know the mentality of cutting the losers and how paper cuts can really add up. Like I said, if you're taking, 10% of your account on any given trade and you're stopping out at 10%, sometimes you can't even get 10%. Sometimes it just knifes too hard and suddenly it's 15. So 4 losers can add up to 5% of your account really quick. So, especially with the small account, like this can be devastating. So you need to realize that the selection process is is brutally important. Don't just take a trade to be in a trade. You know, cutting losers and being in positions that don't work is directly correlated with being selective. If you find yourself trading too many times, tell yourself like, okay, I'm going to take 3 trades a day. If I lose all of them, I'm going to be done. Take 3 to 4 trades a day. If I lose all of these trades, there will be a max amount that I will have lost. And if I lose 4 in a row, I'm just going to walk away. But also, I find it very valuable to just say, okay, I'm going to take 3 to 4 trades, and all I'm going to do is see how they go. Some might be winners, some might be losers, but I'm going to restrict myself to 3 to 4 trades, and I'm going to walk away after the first hour and a half to 2 hours. That's basically what I do every single day. I walk away. So, say I traded Peloton here, right? If I took it on the confirmation here, there would be not much downside. Sure, it goes up there. You could have taken your gains, but, knife, you probably either stopped out or were break even. You could have taken puts on the confirmation below here and then taken them down to here. But again, you probably stopped out break even because at most you were probably up 3%. This level, while it was quote unquote respected, it still just played around with the level too much to really give any, super good return or any super good play. So on something like this, it's important to realize, you see this chop happening and just say, you know what, there are better plays out there. I don't need to force Peloton today. While at the same time, we can get frustrated, right? Paper cuts can definitely add up. But even though they can add up, the important thing is that we keep our position sizing consistent, right? We're not like, oh, wow, well, I just took 4 paper cuts in a row. I'm really upset. I'm just going to, lob half of my account into my next play. And then as long as that goes 10%, I'll win. I'll be green on the day. Well, that is a really bad position to put yourself in, because if that does exactly what the previous 4 did, then you're in an even deeper hole than you were before. So losers will happen. It's part of the game. You can't possibly avoid it. And then re-entries, right? This is kind of the same thing with being selective. If you really, really, really like the setup and you think that it could continue to go in your favor here, so like say you were looking to re-enter Peloton here, this would have been way too high, wouldn't have entered. Here, you could have thought the same thing, okay, maybe it will break out this time. You again, you would have been green, but then realizing that it would have been the big resistance of the day, you probably would have cut up here. But it's important, again, be selective. Realize what does the chart even tell me here? So actually, Facebook is a good example of a reentry. So earlier today, what I did was I took Facebook calls here, noticing that this support was holding. I actually stopped out down here, because I said, you know what, I'm down, almost 10%. I'm cutting these because this is the last line of defense right here at 323.75. So I'm cutting these calls, and then boom, what did it do? It ripped. And I was like, wow, well, that really stinks. But it came right back down, tested it again. I had that minus 10% loss. Of course I was frustrated about it. However, I was able to see that, I got actually more tests of this level and saw that this level is more significant, and it provided me an even better entry. So would you rather take the minus 10% loss, or would you rather sit through all of this and then, you would have probably been down here, or, say you probably would have been up here, but if you didn't take the profits, you probably would have been down here, and then you would have possibly stopped out here, and then you would have missed out on this entire move. There's any number of things that could have happened, but basically, the moment your thesis becomes invalid, you get rid of it, okay? Thesis became invalid here, got rid of it. And I'm still looking. I'm not giving up on Facebook just because it gave me a minus 10. I'm looking and boom, had a great entry here. And the good thing about minus 10 is you're not going to have any revenge or, anguish for a certain stock, because, minus 10 is a paper cut. It's not going to kill you. However, if it goes minus 25%, so suppose Facebook kept going here, and then I sold, and then it ripped, I would probably be pretty mad about that. We've all been there. We all feel like that happens to us every time. An additional note that I should mention here is we always, as far as stopping out, we always notice the ones where we stop out and then it keeps ripping, but we never really think about the ones that we stop out and it keeps going against us. So that's a very important thing to think about. And lastly, psychology behind recovering from large losses, but not only that, staying mentally strong after big wins. So, recovering from large losses. My best advice, and it's not financial advice, I'm not a financial advisor, but uh, when I have any sort of drawdown, I like to keep my position sizing small, and I like to see the ball go through the rim, right? Shoot a couple free throws, get some 10% here, 15% there. Just watch the small wins add up. And for me, I've always been surprised with when I just focus 100% on discipline. The goal is not about the P&L. The goal is about the discipline. And when I focus on the discipline and then I just follow my rules, all the rules that I've laid out here, I follow them to a T. I look and I say, oh my gosh, there's my P&L. It's green and it's glorious, right? After having a setback, you need to just sit back, relax, take a deep breath, and watch the base hits. Just watch the base hits add up. Don't think I'm going to recover this all in a day. Say, you know what, maybe I lost a ton of money yesterday. But you know what? Today's a new day. And what I can do, the only way I can get it back is by compounding. Compound, compound, compound. And just get it back over time. Prove to yourself and build your confidence in yourself. Invest in yourself. Prove to yourself that you can do it. And increase your confidence by taking the small wins, the base hits. Always the base hits. And suppose you're on a huge green winning streak. It's important to not feel invincible, because if you feel invincible, that can lead to increased position sizing. It can lead to averaging down. It can lead to becoming tunnel visioned, thinking that whatever you're doing is what's going to happen. So what I want to be very, very clear on is to stay neutral and level-headed. Sure, winning feels incredible, and we all go through these emotions many times throughout our trading careers. But the important thing is just to keep a very neutral mentality, come into the market realizing that every day is a new day, just prepared to take exactly what it's going to give us. And make a plan, stick to it. Many small wins add up, I promise. And consistency is a byproduct of discipline. Stay disciplined. And lastly, levels don't lie. Thank you.